The million-dollar question nobody wants to answer. You're about to learn something that will fundamentally change how you see trust, business, and human behavior. Who commits fraud? The answer is going to surprise you, maybe even disturb you a little. Because we're not talking about shady criminals in dark alleys. We're talking about educated professionals, trusted employees, people who look exactly like the person you see in the mirror. Whether you're watching this at 2 a.m. during a study marathon, on your lunch break, or between back-to-back classes, welcome. What you're about to learn in the next 75 minutes will give you insight that most business professionals never develop, even after decades in the field. Here's what makes this topic so powerful. Understanding who commits fraud and why isn't just academic theory. This is practical knowledge that protects organizations, saves careers, and honestly, it might save you from making a catastrophic mistake someday when the pressure gets real. Patricia Smith was a trusted controller at a car dealership, educated, experienced, respected. She embezzled $10.3 million over several years. During the COVID-19 pandemic, 2 professionals in California allegedly filed $144 million in false health claims. These weren't career criminals. They were people with credentials, responsibilities, families. So what happened? That's what we're here to investigate. By the end of this lecture, you'll understand fraud at a level that separates good accountants from exceptional ones. You'll recognize behavioral red flags before financial symptoms appear. You'll understand the psychology that drives trust violations. And most importantly, you'll know how to build systems that actually prevent fraud by addressing the root causes. This isn't about memorizing definitions. This is about understanding human nature, organizational dynamics, and the dangerous intersection where opportunity meets pressure, meets rationalization. Your journey from surface-level awareness to deep comprehension starts right now. Let me be clear about something. I'm not teaching you how to commit fraud. I'm teaching you how to think like a fraud examiner, how to protect like a guardian, and how to understand like a psychologist. Because the professionals who master this material, they become the people organizations turn to when millions of dollars are at stake. They command higher salaries because they possess rare insight. They sleep better at night because they've built bulletproof systems. That person can be you. Let's get into it. Criminology meets your Spotify Wrapped. Why people follow rules. Let's start with a fundamental question that sounds simple but gets deep really fast. Why do people follow rules? Seriously, think about it. Why do you stop at red lights when no one's watching? Why do you pay for your Uber Eats instead of just taking the food? Why do most employees not steal from their employers even when they easily could? Criminology is the study of crime and criminal behavior, but really it's the study of human decision-making under temptation. And understanding this gives you a competitive advantage that most people never develop. There are 3 main reasons people obey laws and rules. First, fear of punishment. You don't want to get caught, arrested, fired, or sued. That's the obvious one, and honestly, it's the weakest motivator. Second, desire for rewards. Following the rules leads to promotions, bonuses, social status, and opportunities. You've seen this in action when you decide to do quality work, even when you could slack off because you want that good grade or that recognition. Third, and this is the most powerful, moral responsibility. Most people follow rules because they genuinely believe it's the right thing to do. They view laws and ethical standards as fair and necessary for society to function. This isn't fear-talking. This is identity. This is who they believe they are. Here's what's fascinating. Society depends on voluntary compliance. We don't have enough police officers to watch everyone. We don't have enough auditors to check every transaction. We don't have enough cameras to monitor every moment. The system works because most people, most of the time, choose to do the right thing based on internalized ethics rather than external enforcement. Think about your favorite game, whether it's Fortnite, Call of Duty, or Valorant. The game has rules, but some players still cheat. The interesting players aren't the obvious hackers. It's the ones who exploit gray areas. the ones who say, technically, I'm not breaking the rules, while violating the spirit of fair play. That's exactly what we're studying in fraud. Now here's where it gets real. When we study occupational fraud, we're studying what happens when that internal moral compass gets disrupted, when smart, educated, previously honest people make decisions that violate everything they claim to believe. Occupational fraud is using your job for personal enrichment through deliberately misusing your employer's resources. It's clandestine, meaning hidden and deceptive. It's a breach of fiduciary duty, meaning you violated the trust placed in you. It creates financial benefit for you while causing organizational loss. And the wild part, the people who commit it often started their careers as rule followers. Something changed. Understanding what changed, that's where the power is. White-collar crime isn't wearing a suit. It's wearing a disguise. Edwin Sutherland coined the term white-collar crime back in 1949, and he was talking about crimes committed by respectable business or professional men. Now, we'd obviously update that language to include all genders, but the concept remains crucial. These are typically nonviolent crimes committed by educated, trusted individuals motivated by greed, power, or opportunity. This isn't someone robbing a convenience store. This is someone manipulating financial statements, embezzling through sophisticated schemes, or defrauding stakeholders using their position and knowledge. Here's what makes white-collar crime so dangerous. It hides behind legitimacy. When Bernard Madoff ran his Ponzi scheme, he wasn't wearing a mask and carrying a weapon. He was wearing expensive suits, sitting in a prestigious office, and using the language of sophisticated investing. His victims trusted him precisely because he looked successful, acted professional, and seemed legitimate. The disguise was respectability itself. And this pattern repeats constantly. The trusted accountant, the respected executive, the long-term employee everyone loves, they don't look like criminals because our mental image of criminals is completely wrong. Let's connect this to something you know. Remember when that viral story broke about influencers promoting crypto scams? Or when certain YouTubers got exposed for pump and dump schemes? Same principle. They built trust through consistent content, developed parasocial relationships with followers, cultivated an image of success and expertise, and then exploited that trust for financial gain. The medium changed from corporate boardrooms to social media platforms, but the psychology? Identical. Trust is the setup, exploitation is the punchline. Except nobody's laughing when the money disappears. The overlap between white-collar crime, occupational fraud, and economic crime is significant. These terms often get used interchangeably, and while there are technical distinctions, the core truth remains. We're talking about violations of trust by people in positions of access and authority. You need to understand this because when you become a forensic accountant or auditor, you're not looking for obvious criminals. You're looking for behavioral anomalies in trusted colleagues. You're searching for red flags in routine transactions. You're investigating people who, on the surface, seem completely normal. This is profiling without stereotyping, detection without prejudice, and investigation without assumption. Organizations can be criminals too when companies go bad. Now let's level up the complexity. Individual people commit fraud, but so do organizations. Organizational crime refers to illegal acts committed by otherwise legitimate entities. Corporations, nonprofits, even government bodies. Think about Wells Fargo opening millions of fake accounts to hit sales targets. That wasn't just individual employees going rogue. That was organizational pressure, cultural dysfunction, and systemic failure, creating conditions where fraud became normalized. The institution itself became the criminal enterprise. Examples of organizational crime include unfair pricing schemes where companies coordinate to fix prices and eliminate competition, deceptive marketing that makes false claims about products or services, Foreign Corrupt Practices Act violations where companies bribe foreign officials to win contracts, tax evasion strategies that go beyond legal avoidance into illegal concealment, environmental violations, safety regulation breaches. The list goes on. And here's what's legally important. Corporations can be held criminally liable, just like individuals. The company itself can be prosecuted, fined, and sanctioned. Let's make this real with current examples. When pharmaceutical companies got caught manipulating opioid prescription data and downplaying addiction risks, that was organizational crime on a massive scale. When tech companies faced allegations of privacy violations and data misuse, those investigations examined organizational behavior and corporate decision-making structures. When automotive manufacturers installed emissions defeat devices to cheat environmental tests that required organizational coordination and institutional knowledge, one person can't pull that off. It takes systems, processes, and collective participation. For you as future accountants and fraud examiners, this matters because you need to investigate beyond individual perpetrators. You're examining organizational culture, management tone at the top, incentive structures that reward unethical behavior, and control systems that either prevent or enable misconduct. When you're analyzing a company's financial statements, you're not just checking numbers. You're reading the story those numbers tell about organizational character, values and action, versus values and mission statements, and the gap between what leadership claims and what systems actually reward. Organized crime goes corporate, the enterprise of illegality. Organized crime sounds like something from a movie, right? The Godfather, Goodfellas, Breaking Bad. But modern organized crime looks more like a multinational corporation than a street gang. We're talking about complex networks of individuals and shell companies engaged in illicit activities that cross jurisdictions, blur legal boundaries, and generate massive profits. And the accounting? Sophisticated. These operations need money laundering to conceal illegal proceeds, mail and wire fraud using communication systems, and conspiracy charges for collaborative planning of illegal acts. The goal of organized crime is converting illegal gains into legitimate-seeming income. Think about it like this. If you made $10 million selling illegal goods or services, you can't just deposit that into Bank of America and buy a mansion. That triggers investigations instantly, so you need layers. You create shell companies in different jurisdictions. You establish businesses that handle lots of cash, so illegal money blends with legitimate transactions. You make investments through intermediaries. You use complex financial instruments to obscure the money trail. It's accounting in reverse. Instead of creating transparency, you're engineering opacity. The RICO Act, which stands for Racketeer Influenced and Corrupt Organizations Act, was designed to dismantle these enterprises. It outlaws investing illegal funds in legitimate businesses, acquiring businesses through illegal acts, and conducting business using funds from illegal activities. RICO gives prosecutors powerful tools to target entire organizations rather than just individuals. And here's where it gets interesting for you. Understanding RICO means understanding how financial systems can be weaponized, how legitimate business structures can be corrupted, and how forensic accountants trace money flows to reveal criminal enterprises. Let me connect this to something more relatable. Remember when everyone was talking about NFT rug pulls and crypto scams? Some of those operations functioned exactly like organized crime. Create a project with initial legitimacy, build hype through coordinated social media campaigns, attract investors through FOMO and promises of wealth, then extract value and disappear, leaving holders with worthless digital assets. Was it technically organized crime? Sometimes yes, sometimes gray area. But the structure, the methodology, the psychology of exploiting trust at scale, identical patterns playing out in different contexts. Civil versus criminal, when money talks and courts listen. Before we dive deep into who commits fraud, you need to understand an important distinction: the difference between torts and crimes, between civil litigation and criminal prosecution. A tort is a private wrong or injury other than breach of contract for which the law allows damages. Think of someone getting sued for causing harm, breaching duty, or creating financial loss. The structure is straightforward. There's a duty owed, a breach of that duty, causation, linking the breach to damages and actual damages that can be quantified and compensated. In tort cases, the burden of proof sits with the plaintiff. You're the one making the claim. You need to prove both that the defendant is liable and that you suffered quantifiable damages. This is different from criminal cases where the government prosecutes and must prove guilt beyond reasonable doubt. In civil cases, the standard is preponderance of the evidence. Basically, more than 50% likely that your version is correct. It's a lower bar, which is why you sometimes see people acquitted in criminal court, but found liable in civil court for the same conduct. Here's why this matters for fraud examination. Many fraud cases result in civil litigation, even when criminal charges aren't filed. The organization sues the perpetrator to recover losses. Victims sue for damages. Shareholders sue management for breach of fiduciary duty. And as a forensic accountant, you might be called as an expert witness to quantify damages, trace misappropriated funds, or explain complex financial transactions to judges and juries who don't have accounting backgrounds. Your ability to translate accounting evidence into persuasive testimony becomes crucial. Let's bring this home with a scenario you might face. Imagine you graduate and join a company. 5 years later, you discover your supervisor has been falsifying expense reports for personal benefit. The company fires the supervisor and wants to recover losses. They could pursue criminal charges, but prosecutors might not prioritize a $50,000 embezzlement case when they're dealing with murders and drug trafficking. So the company files a civil lawsuit. They hire you as the forensic accountant to document every fraudulent transaction, calculate total damages including interest and fees, and testify about your findings. Civil litigation becomes the practical path to accountability and recovery. Understanding both systems gives you options and flexibility in addressing fraud. Now we get to the question that makes everyone uncomfortable. Who actually commits fraud? Let me give you the profile based on decades of research and thousands of cases. The typical occupational fraudster is male, middle-aged to retirement age, well-educated often with accounting or business training, holds a manager or executive position, has been with the organization for 5+ years, typically acts alone rather than with conspirators, and has a clean criminal record with no prior fraud history. Read that again slowly. This isn't the profile of a stereotypical criminal. This is the profile of someone you'd trust completely. Think about what this means. The person most likely to commit significant occupational fraud isn't the new hire you're suspicious of. It's the trusted veteran who knows the systems intimately. It's not the obviously struggling person with visible problems. It's the respected professional who appears successful. It's not the outsider trying to infiltrate. It's the insider with legitimate access and authority. This completely inverts our intuitive threat assessment. We're naturally suspicious of strangers and newcomers, but fraud research tells us the real risk comes from long-term trusted relationships. Let me paint this picture more clearly. Patricia Smith, the controller who embezzled $10.3 million from BioLacura, wasn't a career criminal. She was a 56-year-old accounting professional who worked at the dealership for years. She had the trust of ownership, the knowledge of control weaknesses, and the access to manipulate systems. Nobody suspected her precisely because she fit the profile of someone you'd never suspect. That's not a paradox. That's the pattern. The disguise isn't just professional appearance. The disguise is earned trust over years of legitimate service. Here's where you need to be careful, and I'm being real with you right now. This profile describes many successful accounting professionals, including potentially you in 10 years. Does that mean everyone matching this profile is a fraud risk? Absolutely not. The vast majority of educated, experienced, trusted professionals never commit fraud. But it means you can't rely on stereotypes and assumptions for detection. You need systems, controls, and oversight that work regardless of who the person is. You need to verify without insulting. You need to monitor without micromanaging. You need to trust but verify, believe but confirm, respect but protect. That's the paradox of fraud prevention in professional environments. The founding fathers of fraud theory. Let's talk about the intellectual giants whose research created the foundation we're building on today. Edwin Sutherland is considered the father of white-collar crime research. His work in the 1930s and 1940s revolutionized criminology by showing that crime wasn't just a lower-class phenomenon. Educated, wealthy, respected professionals committed crimes too, just different types of crimes with different methods. His theory of differential association argued that crime is learned behavior transmitted through communication and intimate personal groups. You learn to be a criminal the same way you learn to be a professional, through observation, instruction, practice, and reinforcement. Donald Cressy took Sutherland's work and focused specifically on what he called trust violators, people in positions of financial trust who violated that trust for personal gain. His 1953 research interviewed imprisoned embezzlers and identified patterns in their decision-making processes. What he discovered became the foundation of fraud theory. Fraud isn't random, it's predictable. It requires specific conditions to occur. Remove those conditions, and you prevent the fraud. This was revolutionary thinking that transformed fraud prevention, from hoping people would be honest to engineering environments where fraud becomes difficult. Steve Albrecht came along in 1991 and expanded Cressy's work by introducing personal integrity as a measurable factor. He created the fraud scale, which we'll explore in depth later, that quantified the relationship between pressure, opportunity, and integrity. His research showed that fraud isn't just about external circumstances. Personal character and ethical values matter significantly. Two people facing identical pressures and opportunities might make different choices based on their internal moral framework. This added psychological depth to what had been primarily sociological theory. Hollinger and Clark investigated workplace deviance and employee theft from a different angle. They found that job dissatisfaction was a major driver of unethical conduct. Employees who felt mistreated, undervalued, or unfairly compensated were significantly more likely to rationalize theft as evening the score, or taking what I deserve. This research revealed how organizational culture and management practices directly influence fraud risk. Treat employees well, create fair systems, recognize contributions, and fraud risk decreases measurably. Create toxic cultures, tolerate unfairness, reward bad behavior, and you're actively cultivating fraud risk. The organization itself becomes either a preventive factor or a contributing cause. The fraud triangle, 3 sides to every story. Here's where everything comes together into the most influential framework in fraud examination, the fraud triangle. Donald Cressy developed this model, and despite being created decades ago, it remains the foundation of how we understand fraud today. The triangle has 3 sides: perceived pressure, perceived opportunity, and rationalization. Remove any one of these 3 elements, and fraud doesn't occur. All 3 must be present simultaneously for someone to violate trust. This is powerful because it means prevention doesn't require perfecting human nature. It requires disrupting the conjunction of events that enable fraud. Let's start with perceived pressure, which Cressy called non-shareable financial problems. These are problems the person believes they cannot share with others without damaging their reputation, status, or relationships. It's not just having financial problems. Lots of people have money issues and never commit fraud. It's having problems you feel desperate to hide and solve secretly. Cressy identified several categories: violation of obligations like gambling debts or addiction expenses, personal failures like bad investments or business losses that threaten your image of success, business reversals where your company is failing and you need to hide losses, status-gaining desires where you're trying to appear wealthier than you are, or employer-employee conflict where you feel mistreated and want revenge. The theme running through all these pressures is fear of losing status and desperate need to maintain appearances. Think about your social media presence. How much energy do people put into appearing successful, happy, and thriving even when real life is messy? That same psychology drives fraud. Someone who's actually struggling financially but projects success on Instagram is facing the same internal contradiction as the executive whose investments failed but who can't admit it without losing credibility. The pressure isn't just the financial problem itself. The pressure is the gap between reality and image. between actual circumstances and projected success. That gap creates desperation. Now, I know some of you are thinking this doesn't apply to you because you're not hiding financial problems. Fair enough. But stay with me, because life comes at you fast. 5 years from now, you might face a medical emergency not covered by insurance. 10 years from now, you might make an investment that goes bad. 15 years from now, you might face family obligations that strain your resources. The question isn't whether you'll face pressure. The question is how you'll respond when you do. Understanding these patterns now prepares you to recognize them in yourself and others, to build support systems that prevent desperation, and to create organizational cultures where seeking help is strength rather than weakness. Opportunity knocks, but only when the door is unlocked. The second side of the fraud triangle is perceived opportunity. This is where your accounting and control knowledge becomes crucial. Fraud occurs when individuals believe they can exploit weaknesses in systems, processes, or oversight without getting caught. Notice the word perceived. It doesn't matter if the opportunity is real or imagined. What matters is whether the potential fraudster believes they can succeed. This is why the perception of detection is the strongest preventive force in fraud deterrence. It's not about catching everyone. It's about making everyone believe they'll be caught. Cressy identified two components of perceived opportunity: general information and technical skill. General information means knowing that positions of trust can be violated. Everyone knows this abstractly. But technical skill means having the specific capability to execute the fraud. This is where your accounting education becomes either a preventive asset or an enabling liability. You're learning how to record transactions, manipulate accounts, prepare financial statements, and navigate complex systems. That knowledge protects organizations when used ethically. That same knowledge enables fraud when ethics fail. This is why integrity matters so much in our profession. Let's make this concrete. Imagine you work in accounts payable with the authority to process vendor payments. Opportunity exists if you have access to create new vendors in the system, authority to approve payments without secondary review, knowledge of how the payment process works from request to disbursement, and belief that monitoring is weak or non-existent. You don't have to actually exploit these weaknesses. The fraud triangle just says you need to perceive that you could. That perception combined with pressure and rationalization becomes dangerous. Remove any element. Segregate duties so no one person controls the entire process. Implement mandatory secondary approval for new vendors. Increase monitoring visibility, and you break the triangle. Here's what's crucial for you as future accountants. Internal controls only work when people know they exist and believe they're effective. You can have the most sophisticated control system in the world, but if employees think it's just bureaucratic theater that nobody actually enforces, it provides zero deterrent effect. This is why control testing and visible enforcement matter enormously. When someone gets caught violating controls and faces real consequences, everyone else notices. That visibility creates organizational learning and recalibrates everyone's perception of opportunity. The goal isn't catching fraud constantly. The goal is creating environments where fraud seems impossible to succeed at. Rationalization, the story we tell ourselves. The third side of the fraud triangle is rationalization, and this might be the most psychologically fascinating element. Rationalization is the cognitive process that allows fraudsters to justify their actions and maintain their self-image as honest people. Here's what makes this so important. Rationalization occurs before the act, not after. People don't commit fraud and then figure out how to feel okay about it. They convince themselves it's acceptable first, then commit the act. This means the fraudster doesn't view themselves as a criminal. They view themselves as someone dealing with an unfair situation in a justified way. Cressy identified 3 categories of trust violators based on their rationalization patterns. Independent businessmen used what he called borrowing rationalization. I'm not stealing, I'm just borrowing. I'll pay it back. These were often business owners or executives who convinced themselves they were temporarily using funds they'd eventually replace. Long-term violators typically embezzled gradually, sometimes over years or decades, and justified it through necessity or revenge. The company owes me this, or I'm underpaid for my contributions, or they'd waste this money anyway, at least I'm using it productively. Absconders took money and fled, usually had lower organizational status and less attachment to the organization, and often rationalized through desperation. I have no other choice. The rationalizations sound almost ridiculous when you hear them stated plainly. But that's the power of cognitive distortion under pressure. Your brain is incredibly good at constructing narratives that preserve your self-image. Think about simpler examples you've probably experienced. You torrent a movie instead of paying because these studios make billions anyway. Or, I wouldn't have paid for it anyway. So it's not really theft, or everyone does it. You pad an expense report because I do so much unpaid overtime, this evens things out. Or, my manager does it too. Or, the company has plenty of money. These are practice runs for the rationalization patterns that enable serious fraud. Here's what you need to understand. Rationalization is the most insidious element because it's invisible to external observers and happens entirely in the perpetrator's mind. You can implement controls that reduce opportunity. You can create support systems that relieve pressure, but you cannot directly control someone's ability to rationalize. What you can do is create organizational cultures that make rationalization harder. How? Clear ethical standards consistently enforced. Visible consequences for violations regardless of status, leadership modeling integrity, not just demanding it, open communication channels where problems can be shared without shame, regular ethics training that challenges common rationalizations directly, make it culturally difficult to tell yourself this is okay when it's clearly not. The conjunction of events when 3 becomes catastrophe. The fraud triangle requires all 3 elements to be present simultaneously: pressure, opportunity, and rationalization. This is called the conjunction of events, and it's crucial for prevention strategy. Why? Because you don't need to eliminate all 3 factors completely. You just need to remove one element reliably, and fraud becomes unlikely. This is the power of the framework. It transforms fraud prevention from an overwhelming challenge into a strategic problem with specific intervention points. Let's walk through some practical applications. If you reduce opportunity through strong internal controls, you break the triangle even if pressure and rationalization remain present. Someone might feel desperate financial pressure and have already convinced themselves that borrowing from the company would be justified. But if they genuinely cannot access funds without detection, fraud doesn't occur. They might dream about it, might fantasize about it, might even plan it theoretically, but execution becomes impossible. Controls create that impossibility. Alternatively, if you reduce pressure through support systems, you break the triangle from a different angle. Maybe someone has technical ability to manipulate accounts and has already rationalized that their company owes them. But if they receive a bonus that solves their financial crisis, or if they get approved for a hardship loan, or if their gambling addiction gets treated, the motivating force disappears. Opportunity and rationalization might persist, but without pressure, driving action, fraud doesn't happen. This is why employee assistance programs, mental health resources, and financial wellness support matter beyond just being nice benefits. They're fraud prevention strategies. You can even address rationalization directly through culture and ethics programs. Someone faces financial pressure and has access to exploit control weaknesses, but if the organization has created such a strong ethical culture that they cannot convince themselves this would be acceptable, fraud doesn't occur. This is the hardest element to influence, but potentially the most powerful, because it creates internal resistance rather than relying on external controls. When people police themselves through genuine ethical commitment, you've achieved the highest form of fraud prevention. The practical takeaway: your fraud prevention strategy should target all 3 elements simultaneously, but with recognition that breaking just one element succeeds. Implement controls that reduce opportunity. Create support systems that relieve pressure. Build cultures that challenge rationalization. This multi-layered approach provides redundancy. If one defense fails, others remain effective. That's sophisticated risk management informed by behavioral science and psychological reality. Red flags wave before money disappears. Here's something that will make you valuable immediately in any organization. The ability to recognize behavioral red flags before fraud shows up in financial statements. By the time you see unexplained account discrepancies or missing funds, the fraud has been occurring for a while. But behavioral indicators often appear first. These are changes in conduct, lifestyle, or demeanor that signal something is wrong. Learning to read these signals gives you early warning capability that can prevent massive losses. The most common red flags include living beyond one's means, someone whose lifestyle doesn't match their known salary, that colleague who suddenly drives a luxury car, takes expensive vacations, and wears designer clothes on a $45,000 salary. That's a red flag worth exploring. Financial difficulties are another indicator, especially when someone seems desperate or discusses money problems constantly. Close relationships with vendors or customers can signal kickback schemes or bid rigging. Control issues where someone refuses to share duties, never takes vacation, and gets defensive about oversight suggest they might be hiding something that would be discovered if someone else handled their responsibilities temporarily. Sudden behavioral changes matter enormously. The previously reliable employee who becomes irritable and defensive, the usually conservative person who starts gambling heavily, the long-term worker who suddenly seems paranoid or secretive, the collaborative team member who isolates themselves. These changes don't automatically mean fraud, but they warrant attention. People don't fundamentally change behavior without reason. Something is driving the change, and sometimes that something is the stress of maintaining fraudulent activity. Now, I need to emphasize something crucial. Red flags indicate possibility, not certainty. You cannot assume someone is committing fraud just because they match a profile or display warning signs. That's discriminatory, potentially illegal, and organizationally destructive. What you can do is use red flags to inform risk assessment and monitoring priorities. If someone displays multiple red flags, increase oversight on their areas of responsibility. Conduct surprise audits, require secondary approvals, shorten review cycles. You're not accusing anyone. You're being appropriately cautious while gathering information. That's professional fraud examination, not workplace harassment. The fraud scale, integrity, enters the equation. Steve Albrecht looked at Cressy's fraud triangle and said, "Something's missing." Two people can face identical pressure and opportunity, but make different choices. Why? Personal integrity. Albrecht developed the fraud scale to quantify the relationship between pressure, opportunity, and personal integrity. The scale essentially says fraud likelihood increases with pressure and opportunity, but decreases with integrity. High integrity creates resistance even when pressure is intense and opportunity is abundant. Low integrity means even minor pressure combined with small opportunities might trigger fraud. The fraud scale operates across two domains: perpetrator characteristics and organizational environment. Perpetrator characteristics include personal behaviors, attitudes, stressors, and ethical framework. Someone with strong ethical values, stable finances, healthy coping mechanisms, and integrity will resist fraud even under significant pressure. Someone with weak ethical boundaries, financial desperation, addictive behaviors, or entitlement mentality becomes high risk quickly when opportunity presents itself. These are internal factors, and honestly, they're harder to assess and influence than external factors. Organizational environment encompasses internal controls, oversight systems, management tone, and cultural values. Weak controls, absent oversight, ethical hypocrisy from leadership, and cultures that reward results regardless of methods create environments where fraud flourishes. Strong controls, active monitoring, leadership integrity, and cultures that prioritize ethics over short-term profits create environments where fraud struggles to survive. These are external factors, and they're much more controllable through deliberate organizational design. Here's why the fraud scale matters more than just the triangle. It acknowledges that prevention isn't just about systems and circumstances. Character counts. Integrity makes a difference. This doesn't mean we rely on integrity instead of controls. That would be naive. But it means we recognize that hiring people with genuine ethical values, continuously developing ethical reasoning skills, and creating cultures that support integrity provides an additional protective layer. When you combine strong personal integrity with robust organizational controls and supportive environments that reduce pressure, you create conditions where fraud becomes truly unlikely. That's the goal, not just making fraud difficult, but making it nearly impossible through multiple reinforcing defenses. The fraudster's playlist: money, ideology, coercion, and ego. Let's shift our approach and think about fraud motivations through a different framework called MICE. This originally came from intelligence agencies studying why people become spies or traitors, but it applies perfectly to occupational fraud. MICE stands for money, ideology, coercion, and ego. These four motivators explain why people violate trust, betray organizations, and commit fraud. Understanding them helps you predict risk, investigate suspicious behavior, and design prevention strategies that address actual motivations rather than assumed ones. Money is the most obvious and common motivator. Financial need, greed, desire for luxury, funding addiction, maintaining appearances, all of these are money-driven frauds. When someone embezzles to pay gambling debts, that's money motivation. When an executive manipulates stock prices to trigger performance bonuses, that's money motivation. When an employee creates fake vendors to receive kickback payments, that's money motivation. This is what most people think of when they imagine fraud. It's direct, understandable, and relatively straightforward to detect if you're looking for lifestyle income mismatches. Ideology as a fraud motivator means acting based on beliefs, causes, or principles. Someone who believes their company is harming the environment might leak confidential documents or sabotage projects. An employee who thinks executive compensation is obscenely unfair might rationalize theft as redistributing wealth. A worker who feels their employer supports causes they oppose might justify fraud as undermining an immoral organization. Ideology-driven fraud is dangerous because the perpetrator views themselves as righteous. They're not criminals in their own minds. They're activists, whistleblowers, or justice seekers. This makes them harder to detect because they often show no traditional red flags like financial stress. Coercion means someone is being forced or pressured into fraud by threats. This could be explicit threats of violence, blackmail over embarrassing information, threats to employment or career, or pressure from organized crime. Coerced fraudsters are often victims themselves, caught between their organization and external threats. They might want to report the situation, but fear consequences. Detecting coercion requires looking for signs of fear, unusual behavior changes, reluctance to discuss certain topics, or evidence of external pressure. Ego and entitlement round out the framework. Some people commit fraud because they believe rules don't apply to them. They deserve special treatment. They're smarter than everyone else and won't get caught, or they're insulted by controls that suggest distrust. Ego-driven fraudsters are often higher-level executives or professionals with significant authority. They view internal controls as offensive bureaucracy beneath their status. They rationalize fraud as, "my money anyway," or "I built this company," or "I'm too important to follow petty rules." Ego fraud is particularly damaging because it often occurs at high levels where oversight is weak and amounts are large. Predators versus situational fraudsters, two different animals. Not all fraudsters are created equal. Research identifies two fundamentally different types: situational fraudsters and predatory fraudsters. Understanding the distinction changes how you think about prevention, detection, and response. Situational fraudsters are generally honest people who commit fraud under pressure or unusual circumstances. They're reactive rather than proactive. They fit Cressy's fraud triangle perfectly because they need all three elements: pressure, opportunity, and rationalization to act. These are the people who say, "I never thought I'd do something like this." Predatory fraudsters are completely different animals. They actively seek fraud opportunities. They're driven by greed rather than need. The fraud triangle doesn't fully apply because they often lack genuine pressure and barely need rationalization. They simply view fraud as a profitable option and pursue it deliberately. Predatory fraudsters are proactive, strategic, and often serial offenders. If they can't commit fraud in one organization, they'll move to another that offers better opportunities. They chose careers partially based on fraud potential, rather than ending up in fraud despite their career choice. Let's break down the key differences. Situational fraudsters are generally older, more educated, often have addiction or control issues, commit smaller frauds over longer periods, get discovered accidentally or through tips, and are more common in the United States. Their fraud is often discovered when they make a mistake, when control procedures catch an anomaly, or when someone notices behavioral red flags. Predatory fraudsters tend to be younger, less educated, don't typically show addiction patterns, commit larger frauds over shorter durations, get caught through internal audit or law enforcement investigation, and are more common internationally. Why does this distinction matter? Because prevention strategies that work for situational fraudsters might not work for predators. Strong internal controls deter situational fraudsters by reducing perceived opportunity. But predatory fraudsters view strong controls as challenges to overcome, puzzles to solve, barriers to break through. Supporting employee well-being reduces pressure that drives situational fraud. But predators aren't motivated by pressure, so support systems don't deter them. Predators require more aggressive countermeasures, proactive fraud detection programs, continuous monitoring, regular surprise audits, background checks, and rapid response to suspicious activity. The career implication for you: when you're doing fraud examination, you need to assess which type of fraudster you're dealing with. Situational fraudsters often cooperate with investigations, show remorse, provide full disclosure, and can sometimes be rehabilitated. Predators fight investigations, show no genuine remorse beyond getting caught, provide minimal information, and typically reoffend if given the opportunity. Your investigation approach, interviewing strategy, and recommendations should differ dramatically based on this assessment. One size does not fit all in fraud examination. Collusion changes everything when fraudsters team up. Up until now, we've mostly discussed individual fraudsters, but here's where it gets more complex and more dangerous: collusion. When two or more people collaborate to commit or conceal fraud, detection difficulty increases exponentially, and typical losses increase dramatically. The AICPA identified collusion and management override as the Achilles heel of internal controls. Why? Because controls assume separation of duties will prevent fraud. When the separated parties secretly cooperate, the entire control structure fails. A CFE research on collusion reveals disturbing patterns. Collusive frauds result in larger dollar losses despite shorter durations before detection. Two people working together can steal more money faster than one person working alone. Co-offenders are typically chosen for their complementary skills or access to different control points. One person might have vendor approval authority, while their accomplice processes payments. One might prepare financial statements while their partner reviews them. The collusion creates the appearance of proper control, while systematically defeating the actual purpose. Demographics of collusive fraudsters differ from solo operators. Collusive fraudsters tend to be younger than solo fraudsters, have less education on average, show lower rates of addiction or control issues, and commit frauds that are larger in amount but shorter in duration. Why younger? Possibly because younger employees have less to lose, face more financial pressure early in careers, or haven't yet internalized organizational loyalty that inhibits betrayal. Why shorter duration? Because multiple people sharing fraud proceeds need larger amounts faster, and because more people involved means more chances for someone to make a mistake or have a crisis of conscience. Detection of collusive fraud typically occurs through tips, internal audit discoveries, or law enforcement investigations rather than accident or control procedures. This makes sense because controls designed to prevent individual fraud fail when multiple people cooperate to defeat them. It also explains why anonymous reporting systems are so crucial. When employees see colleagues collaborating on something suspicious, they need a safe way to report concerns without fear of retaliation. Organizations that suppress whistleblowing, discourage reporting, or retaliate against those who raise concerns essentially protect collusive fraud. The international dimension matters too. Collusive fraud is more common outside the United States, possibly due to different cultural values around individualism versus collectivism, different control standards, different legal frameworks, or different enforcement environments. For you as future forensic accountants, this means international investigations require heightened awareness of collusion possibilities, more extensive testing of control compliance, deeper investigation of relationships between employees, and careful examination of segregation of duty failures. Let me give you something concrete you can reference throughout your career. This slide summarizes behavioral red flags that frequently accompany fraud. Screenshot this, save it, review it when you're evaluating employees, conducting audits, or investigating suspicious activity. These aren't proof of fraud, they're indicators that warrant additional attention, closer monitoring, or investigation to either confirm or rule out misconduct. Living beyond means manifest as luxury purchases inconsistent with salary, frequent high-end vacations, expensive vehicles, designer clothing, jewelry, or electronics, constant discussion of expensive hobbies or activities, lifestyle upgrades with no apparent legitimate funding source. Be careful here because some people have legitimate outside income sources, inheritances, or wealthy partners. But significant lifestyle income mismatch deserves discreet inquiry. Financial difficulties present as constant money complaints, requests for advances on salary or time off for financial reasons, wage garnishments or collection calls at work, borrowing money from colleagues or customers, or obvious stress about finances. Again, financial difficulties alone don't indicate fraud. Many honest people struggle financially, but combined with access and opportunity, it becomes more significant. Unusually close associations with vendors or customers are red flags when employees socialize extensively with business partners, share equity in ventures with vendors or customers, hire or recommend hiring of friends/relatives as suppliers, resist vendor diversification or competitive bidding, or get defensive when questioned about business relationships. Healthy business relationships remain professional. When boundaries blur, conflicts of interest emerge and kickback schemes become possible. Control issues manifest as refusal to take vacations, reluctance to share duties or train backup, defensive reactions to questions or oversight, working unusual hours without clear need, or creating dependency where only one person understands certain processes. When someone acts like they're irreplaceable or resists normal control procedures, investigate why. Sudden behavioral changes are particularly important. Irritability or defensiveness, social withdrawal from colleagues, alcohol or drug use changes, appearance changes either for better or worse, relationship problems becoming visible at work, excessive anxiety or paranoia. People don't fundamentally change personality without cause. Sometimes that cause is personal life stress unrelated to work. Sometimes it's health issues, but sometimes it's the psychological burden of maintaining fraud. Behavioral changes deserve compassionate check-ins that might reveal either personal problems needing support or professional misconduct requiring investigation. Either way, addressing the change benefits everyone. Wolf and Hermanson looked at the fraud triangle and proposed adding a fourth element, capability. They argued that some frauds simply cannot be committed by people lacking specific skills, knowledge, authority, or personality traits. It's not enough to have pressure, opportunity, and rationalization. Complex frauds require capable perpetrators. This addition to the model helps explain why certain frauds occur at specific organizational levels and require particular characteristics. Capability encompasses several dimensions. Position and authority within the organization determine what controls someone can override, what transactions they can authorize, what records they can access, and what questions people will ask about their activities. The CFO has capability to commit frauds that a junior accountant cannot because of authority level. Intelligence and creativity enable sophisticated fraud schemes that exploit control weaknesses, anticipate detection methods, and adapt when circumstances change. Technical skills in accounting, IT systems, or specific operational areas enable frauds that less knowledgeable people couldn't pull off even if motivated. Personality traits associated with fraud capability include confidence bordering on arrogance, ability to manage stress and hide guilt, strong coercive personality that can manipulate others, ability to lie convincingly and consistently, and immunity to guilt or shame about consequences. These traits enable fraud execution and concealment. A person might have intense pressure, clear opportunity, and complete rationalization, but if they can't lie effectively or manage the stress of deception, they won't successfully commit sustained fraud. The practical implication for fraud prevention: you need to match control strength to position capability. High-level executives require stronger oversight precisely because their capability to commit fraud is higher. They have authority to override controls, expertise to manipulate complex transactions, and organizational power to intimidate those who might question them. Your control system should reflect this reality through mandatory audits of executive activities, board-level oversight that executives cannot influence, anonymous reporting channels that bypass management, and external auditors with genuine independence. Trusting leadership is fine. Verifying leadership is mandatory. Understanding capability also helps in fraud investigation. When a complex fraud scheme gets discovered, capability analysis helps identify the likely perpetrator or accomplice. Who had the technical knowledge to execute this? Who had authority to process these transactions? Who had access to these systems? Who possessed the personality to maintain this deception? Capability narrows the suspect pool and focuses investigation efficiently. Some frauds essentially announce who committed them through the capabilities required for execution. Jonathan Marks proposed arrogance as another dimension to consider in fraud models. Arrogance manifests as entitlement, belief that rules don't apply to you, conviction that you're smarter than oversight systems, assumption that your contributions excuse your misconduct, or expectation of special treatment based on status or tenure. Arrogant individuals don't just rationalize fraud. They don't believe they need rationalization. In their minds, taking organizational resources isn't theft. It's simply claiming what they deserve or utilizing resources they believe belong to them anyway. Arrogance particularly appears in executive-level fraud. Leaders who built organizations or achieved significant success sometimes develop belief systems where they confuse company assets with personal property. They view governance as insulting bureaucracy, interfering with their vision. They see board oversight as ungrateful attempts to constrain genius. This psychological framework makes fraud feel not just justified, but righteous. The executive isn't stealing. They're managing resources that are rightfully theirs to manage without interference. Think about high-profile fraud cases like Enron, WorldCom, or Theranos. Arrogance permeates these stories. Leaders who believed they were too smart to fail, too important to follow rules, too visionary to be constrained by regulations. Their arrogance didn't just enable fraud, it drove fraud. They genuinely believed normal standards didn't apply to their exceptional circumstances. That arrogance blinded them to ethical boundaries and practical risks. They thought they'd never get caught because they viewed themselves as fundamentally superior to whoever might investigate them. Arrogance also affects fraud investigation and prosecution. Arrogant fraudsters rarely show genuine remorse. They're angry about getting caught, not regretful about the conduct. They blame others. My advisors gave bad counsel. My subordinates misunderstood my directions. The regulations are unclear. They position themselves as victims of overzealous prosecution or jealous competitors. This makes investigations more difficult because they're rarely forthcoming with evidence. It also makes rehabilitation unlikely. Arrogance is a personality trait more than a situational pressure. Without fundamental personality change, which is rare, arrogant fraudsters tend to reoffend. Your takeaway: arrogance is both a red flag and a fraud enabler. When you encounter executives or managers who show contempt for controls, bristle at oversight, demand special treatment, or express belief that normal rules don't apply to them, you've identified fraud risk. This doesn't mean they're currently committing fraud, but it means conditions exist where fraud could easily emerge if opportunity aligns with pressure. Extra oversight, stronger controls, and clear accountability become essential protective measures. Let's go deeper into the psychological dimension of fraud. What's actually happening in someone's mind when they decide to violate trust? Understanding fraud psychology helps you predict risk, recognize warning signs, and design prevention strategies that address actual decision-making processes rather than assumptions about how people think. Fraud isn't typically a sudden, impulsive act. It's usually a progressive process of boundary erosion, ethical compromise, and self-deception that occurs over time. The pathway to fraud often follows a pattern. It starts with rationalization development long before any fraudulent act. Someone begins telling themselves stories. I'm underpaid. The company wastes money anyway. Nobody appreciates my contributions. I deserve this. These internal narratives prepare the psychological foundation for fraud by establishing justifications in advance. Next comes small ethical compromises that test boundaries, padding expense reports by small amounts, taking office supplies home, using company resources for personal benefit. These minor violations demonstrate that rules can be broken and serve as practice for larger violations. As small compromises go undetected, confidence builds. The person thinks, I got away with it, and it was easier than I thought. This success emboldens progression to larger frauds. The amounts increase, the frequency increases, the schemes become more sophisticated. This is why early detection of small violations matters enormously. Catching and addressing minor ethical breaches interrupts this progression before massive frauds develop. Ignoring small violations signals that oversight is weak, and larger violations might succeed too. The psychological burden of fraud creates specific patterns. Fraudsters experience constant fear of detection, stress from maintaining deception, difficulty remembering lies consistently, paranoia about colleagues' awareness, and behavioral changes visible to observers. This psychological strain explains why behavioral red flags often appear before financial symptoms. The person is struggling with internal conflict between their actions and their self-image, between their fear and their greed, between their desire to continue and their fear of consequences. That internal war manifests externally through irritability, defensiveness, isolation, or unusual behavior. Some fraudsters experience cognitive dissonance, the psychological discomfort from holding contradictory beliefs simultaneously. They believe they're honest, while acting dishonestly. Their mind works to resolve this contradiction through increasingly elaborate rationalizations, by compartmentalizing fraud as different from regular dishonesty, by projecting blame onto others or circumstances, or by doubling down on fraud to justify prior acts. This psychological dynamic explains why fraudsters often can't stop voluntarily. Stopping means confronting the uncomfortable truth about what they've done. Continuing means maintaining the rationalization framework that protects their self-image. Real talk: when good people make terrible choices. I know some of you are watching this and thinking, I'd never commit fraud. I believe you. But let me be real with you about something uncomfortable. Under the right combination of circumstances, almost anyone can be compromised. This isn't about you being weak or dishonest. This is about human psychology under extreme pressure. Understanding your vulnerability isn't pessimistic. It's protective. Self-awareness about your risk factors enables you to build safeguards into your life and career. Imagine scenarios that could create the conjunction of events. You graduate, start your career, work hard for 10 years, get promoted to controller, everything is going well. Then your spouse gets seriously ill with a condition requiring treatment your insurance won't fully cover. Medical bills accumulate. You're facing $200,000 in debt with no way to pay it. You can't refinance your house because you already did that for the kids' college. You can't borrow from family because they're struggling too. You feel desperate, terrified, and completely alone. That's pressure. Now add opportunity. You're the controller with access to accounts, knowledge of control weaknesses, and authority to process transactions. You know exactly how you could borrow money temporarily to cover the medical bills. You tell yourself you'll pay it back from next year's bonus, or when you refinance in 6 months, or when you sell some investments. You convince yourself this isn't really stealing because you're planning to return it. That's rationalization. And if you possess the capability, technical skills, and emotional control to execute and conceal the fraud, all elements are present. This isn't hypothetical. This is how fraud happens to good people. Cressy's research showed that most occupational fraudsters were genuinely honest people before their fraud. They didn't start their careers planning to steal. Circumstances changed, pressures emerged, opportunities existed, rationalizations developed, and decisions got made that destroyed careers, families, and lives. Learning from their experiences doesn't mean assuming you're doomed to repeat them. It means recognizing vulnerability so you can build defenses before crisis hits. Your defenses include financial literacy and emergency fund building that creates buffers against sudden pressure, relationship honesty where you can share problems rather than hiding them, professional ethics training that prepares you to recognize rationalization patterns in your own thinking, career choices that prioritize fit and values over just salary, and organizational awareness that enables you to assess whether your employer creates conditions that enable or prevent fraud. These aren't guarantees. Nothing is foolproof. But they're protective factors that reduce your risk significantly. Build these defenses deliberately, consistently, and continuously throughout your career. Here's something that will surprise many people. Courts have been skeptical about the fraud triangle's validity as an expert testimony foundation. Several cases have limited or excluded testimony based on the triangle, arguing that it's more conceptual framework than hard science. Understanding this legal treatment is crucial if you plan to work in forensic accounting, because you need to know what you can and cannot say in court when explaining fraud to judges and juries. Key cases established important precedents. Hopt v. Heaps in 2005 excluded fraud triangle testimony from expert witnesses. Travis v. State Farm, also 2005, ruled that the triangle relies more on judgment than scientific method, making it inappropriate for expert scientific testimony. Kremski in 2017 denied use of triangle-based testimony, continuing the pattern. The concern is that the fraud triangle sounds scientific and authoritative, but hasn't been validated through the rigorous testing that hard sciences require. This creates practical problems for forensic accountants. You can't just testify, "I believe the defendant committed fraud," because pressure, opportunity, and rationalization were present. Courts view this as speculation about mental state rather than factual analysis of evidence. You also cannot use the fraud triangle to imply that someone has a propensity to commit fraud based on circumstances matching the triangle elements. That's prejudicial and legally inappropriate. Matching a profile doesn't prove guilt. Evidence proves guilt. So what can you do in court? Focus on observable facts and concrete evidence. Describe the control weaknesses that existed and how they could be exploited without mentioning opportunity. Document the financial pressures the defendant faced through bank records and bills without labeling it non-shareable financial problems. Present the defendant's own statements showing their justifications without calling it rationalization. You're presenting the same information but framing it as factual documentation rather than theoretical framework application. The alternative model that courts find more acceptable is the triangle of fraud action, which we'll cover soon. This focuses on act, concealment, and conversion rather than psychological states. It's evidence-based rather than motivation-based. You can testify about how the fraud was executed, how it was concealed, and how proceeds were converted without speculating about the defendant's mental state or propensity. This makes it legally defensible while still providing useful framework for fraud investigation and explanation. The triangle of fraud action offers a legally defensible alternative to the fraud triangle for expert testimony. Instead of focusing on psychological conditions that might motivate fraud, it focuses on observable actions that constitute fraud. The three elements are the act itself, concealment methods, and conversion of proceeds. This model is evidence-based, doesn't require speculation about mental state, and holds up better in court because it relies on demonstrable facts rather than psychological inference. The act element addresses how the fraud was executed. What specific actions did the perpetrator take? What transactions were manipulated? What records were falsified? What controls were defeated or bypassed? You're describing concrete behavior. The defendant created 15 fake vendor accounts using variations of their spouse's name and a P.O. box they controlled. They then submitted false invoices totaling $430,000 and processed payments using their authority as accounts payable supervisor. This is factual, observable, and provable through records and witnesses. Concealment methods explain how the perpetrator hid evidence. How were records altered? What false documentation was created? How were auditors deceived? What tactics prevented detection? You're documenting deception. The defendant deleted digital vendor files after payments cleared. They intercepted monthly bank reconciliations before they reached the CFO's desk. They created false supporting documentation showing legitimate services rendered. They spread transactions across multiple accounts to avoid triggering review thresholds. This isn't speculation. This is evidence-based description of what happened. Conversion addresses how the perpetrator benefited from the fraud. Where did the money go? What assets were acquired? How were proceeds used or hidden? This is following the money. The defendant deposited checks into a personal account, transferred funds to investment accounts, used proceeds to purchase a vacation property, and made luxury vehicle payments directly from the controlled vendor accounts. Bank records, property deeds, and transaction histories prove conversion. No psychological analysis required. Why this model works better in court? It sticks to what you can prove, rather than what you infer. You're not testifying about the defendant's mental state, motivations, or propensity. You're testifying about their actions, which are documented and verifiable. The jury doesn't need to understand fraud psychology. They need to understand what the defendant did, how they hid it, and where the money went. The triangle of fraud action provides that framework in legally defensible terms. For you as future forensic accountants, this means structuring your investigations around these three questions. What was the fraud? How was it concealed? How were proceeds converted? Document each thoroughly with evidence. Build your case around observable, provable actions. Save the psychological analysis for internal reports and prevention recommendations. When you're headed to court, focus on the triangle of fraud action rather than the fraud triangle, and your testimony will be more persuasive, more defensible, and more effective. Let me speak directly to those of you who aren't the typical 20-year-old traditional college student. You're working full-time while taking classes, your parents going back to school, your career changers bringing experience from other industries, your first-generation college students building something your family never had access to, your international students navigating a new educational system. I see you. Your presence in this class matters. And your life experience? That's not a disadvantage. That's actually insight that traditional students are still developing. Working students, you're living the concepts we discuss. That paycheck stub showing gross pay, deductions, and net pay. That's accounting documenting your labor value. When your manager discusses labor cost percentages and productivity metrics, they're doing cost accounting with your work as the variable. When your employer offers benefits and retirement matching, those are compensation components affecting organizational financial statements. You don't just study these concepts abstractly. You experience them practically. That creates understanding that classroom theory alone cannot provide. Parents returning to school, your household budget is a live case study in financial management. Income, expenses, savings, investments, debt service. You're doing personal accounting already. The principles we formalize in this course simply structure and systematize what you intuitively understand from managing family resources. When we discuss budgeting variance analysis, you immediately grasp it because you've lived the frustration of unexpected expenses disrupting planned spending. Your practical knowledge provides context that accelerates learning. Career changers, your previous industry experience, gives you perspectives traditional students lack. You've seen how businesses actually operate, what problems organizations really face, and how theory meets messy reality. When I discuss internal controls, you're thinking, yeah, my previous company needed that because when we analyze business decisions, you're connecting to actual strategic choices you witnessed or participated in. That context makes you dangerous in the best way. You can translate between business operations and accounting requirements better than someone who's only seen classroom examples. First-generation college students, you're not just learning accounting. You're building generational wealth through knowledge. Your degree represents opportunity your family hasn't accessed before. That gives your education urgency and meaning beyond just career advancement. You're changing your family trajectory through understanding how businesses work, how money flows, and how financial systems function. That's powerful. That motivates persistence through difficult material. That creates determination that carries you through challenges. Never underestimate the strength you bring from that background. Let's talk about the technology you'll work with in actual practice, because understanding fraud requires understanding the systems where fraud happens. I'm not going to pretend you'll manually post journal entries to paper ledgers. You're working in digital environments using software that automates technical processes. But here's what's crucial. Automation doesn't eliminate the need for accounting knowledge. It amplifies the importance of understanding what you're automating and why. Excel is your foundation tool. You'll use it constantly for data analysis, schedule preparation, account reconciliation, and investigation documentation. When we discuss account analysis, you'll execute that using VLOOKUP to match transactions, pivot tables to summarize patterns, conditional formatting to highlight anomalies, and formulas to calculate balances. Excel doesn't do the accounting thinking. You do the thinking. Excel just processes data faster than manual methods. Learning to translate accounting concepts into Excel functions makes you immediately productive in any organization. QuickBooks is the small business standard for accounting software. It automates recording transactions, preparing financial statements, managing accounts payable and receivable, and tracking inventory. When you understand the accounting behind QuickBooks, you can troubleshoot when it doesn't work correctly, customize it for unique situations, and explain to business owners what the reports actually mean. Without accounting knowledge, you're just clicking buttons and hoping. With accounting knowledge, you're wielding a powerful tool deliberately. Enterprise resource planning systems like SAP, Oracle, or NetSuite integrate accounting with operations, inventory, purchasing, sales, and HR into unified platforms. These systems are complex and expensive, but they're what major corporations use. When you record a sales transaction in ERP, it simultaneously updates revenue accounts, inventory accounts, accounts receivable, and potentially commission calculations for sales staff. Understanding how integrated systems work matters because fraud in modern organizations exploits system integration. Someone might manipulate inventory records, knowing it will automatically affect cost of goods sold and gross profit. Financial apps that everyone uses demonstrate accounting principles in practice. Your Robinhood account shows realized gains versus unrealized gains. That's the distinction between actual sales and paper profits, identical to accounting's treatment of marketable securities. Cash App displays your balance versus pending transactions. That's cash versus accrual basis accounting in your pocket. Venmo's payment history is your accounts payable and receivable ledger. When you understand the accounting behind these apps, you understand them more deeply. You see the principles underlying the user interface. The critical lesson: software makes recording easy, but it doesn't teach you what to record, how to categorize, or why it matters. You still need accounting knowledge to make intelligent decisions about business events, transaction classifications, and financial analysis. Technology is a tool that amplifies your expertise. It doesn't replace expertise. Master the accounting concepts deeply, then leverage technology to execute those concepts efficiently. That combination makes you valuable in any organization. Let me explain how we're going to approach technical terminology throughout this lecture. I never want to lose you in jargon, but I also need to prepare you for professional communication where technical terms are expected. So we're using progressive vocabulary building. Each concept starts in plain English that everyone understands, transitions to accounting terminology with bridges explaining connections, and evolves to professional jargon that practitioners use. This scaffolding lets you build vocabulary naturally without feeling overwhelmed or excluded. Take revenue recognition as an example. In plain English, this is figuring out when you actually count the money as yours, even if you don't have the cash in hand yet. That's understandable immediately. Nobody needs accounting background to grasp the concept. Next level, bridges to technical language. Revenue recognition is the timing of when we record earned income in financial statements, which isn't necessarily when we receive cash. We're introducing technical terms, but connecting them to the plain English version. Professional level uses full jargon. Revenue recognition under ASC 606 requires identifying distinct performance obligations and determining when control transfers to the customer. Another example, matching principle. Plain English version. Making sure the expenses show up in the same time period as the revenues they help generate, so you can see true profitability. Clear, conversational, accessible. Technical bridge. The matching principle requires that costs be recorded in the same accounting period as the related revenues to accurately measure periodic performance. We're formalizing but maintaining clarity. Professional version. Under GAAP, the matching principle dictates expense recognition timing relative to associated revenue realization, enabling accurate determination of net income for discrete reporting periods. That's textbook and technical. Why this progression matters. If I start with professional jargon, I lose students who don't have background knowledge. They get intimidated, tune out, and never build understanding. If I stay in plain English exclusively, I don't prepare you for professional communication. You'd understand concepts, but not be able to discuss them with colleagues, read technical literature, or pass professional exams. The progression respects where you are while moving you toward where you need to be. Throughout this lecture, I'm building vocabulary incrementally. Early slides use mostly plain language, with technical terms introduced parenthetically. Middle slides use technical language regularly, with occasional plain English reminders. Later slides use professional terminology confidently, with minimal translation. By the end, you're fluent in fraud examination vocabulary, not because I lectured about definitions, but because you absorb terminology naturally through repeated exposure and context. That's how language acquisition actually works. That's how you build professional fluency that sticks. Addiction, mental health, and fraud, the uncomfortable connection. We need to talk about something that doesn't get discussed enough in fraud education, the connection between addiction, mental health struggles, and occupational fraud. This is uncomfortable territory because we don't want to stigmatize people dealing with these challenges. But ignoring the connection doesn't protect anyone. Understanding it creates opportunity for intervention that could prevent fraud while helping someone get treatment they need. That's a win-win worth pursuing despite the discomfort. Addiction is a significant fraud risk factor because it creates intense financial pressure that feels non-shareable. Gambling addiction is particularly prevalent in fraud cases because losses accumulate rapidly. The person hides the behavior from family due to shame. They believe they can win back losses if they just keep trying, and they need constant funds to continue gambling. Drug or alcohol addiction creates similar dynamics. Expensive habit requiring regular funding, desperation to maintain access despite declining resources, shame preventing disclosure to family or support systems, and impaired judgment that erodes ethical boundaries. Mental health conditions can contribute to fraud risk through various mechanisms. Depression might lead someone to feel that nothing matters, including ethical standards or future consequences. Anxiety might create such desperation about financial security that short-term solutions through fraud seem necessary despite long-term risks. Bipolar disorder during manic phases might fuel risk-taking behavior, grandiose thinking that rules don't apply, and impulsive decisions without considering consequences. None of this means people with mental health conditions are fraudsters. It means untreated conditions can impair judgment in ways that increase risk. Here's the intervention opportunity that organizations often miss. If you notice behavioral red flags that could indicate addiction or mental health struggles, intervening with support might prevent fraud before it starts. Offering employee assistance programs, mental health resources, and addiction treatment without stigma or career penalty creates alternatives to fraud. The person facing gambling addiction who gets into treatment doesn't need to embezzle to fund their habit. The person with depression who receives proper care might not reach the point of desperation, where fraud seems like a solution. This requires organizational cultures that view mental health and addiction as health issues rather than character failures. When seeking help means risking your career, people hide problems until they become catastrophic. When seeking help means accessing resources without judgment, early intervention becomes possible. As forensic accountants, you're not therapists and shouldn't pretend to be. But you can recognize warning signs, recommend appropriate resources, and support organizational policies that reduce barriers to treatment. That's fraud prevention through human-centered care. That's sophisticated risk management informed by compassion. For any students watching this who are struggling with addiction or mental health challenges, seeking help is strength, not weakness. Treatment is investment in your future, not admission of failure. Resources exist through your school's counseling center, community mental health services, and national hotlines. You don't have to struggle alone. You don't have to let temporary problems derail your entire life. And you definitely don't have to make terrible choices that destroy your career because you felt you had no other options. Help exists. Access it. Fraud isn't a uniquely American phenomenon. It occurs globally, but patterns, methods, and risk factors vary across cultures and regulatory environments. Understanding international fraud dimensions matters increasingly as business globalizes. Organizations expand internationally, and fraud schemes cross borders. The fraud triangle applies universally because pressure, opportunity, and rationalization are human constants. But how those elements manifest differs culturally. Cultural values influence fraud patterns significantly. Individualistic cultures like the United States emphasize personal responsibility and individual accountability, which means solo fraud is more common. Collectivist cultures emphasize group loyalty and relationships, which means collusive fraud involving family members or close associates occurs more frequently. Neither culture is more or less ethical inherently. The manifestation of fraud simply differs based on underlying cultural values about relationships, obligations, and identity. Regulatory environments create different opportunity structures. Countries with weak corporate governance standards, limited enforcement resources, corruption in regulatory agencies, and legal systems that don't effectively prosecute white-collar crime create higher fraud risk. Conversely, countries with strong governance frameworks, active enforcement, independent judiciaries, and severe penalties for violations create lower fraud risk through reduced opportunity and increased detection fear. This isn't about national stereotypes. This is about institutional quality affecting organizational behavior. International fraud schemes often exploit jurisdictional boundaries. Money laundering operations use multiple countries to complicate tracking. Shell companies get established in jurisdictions with weak transparency requirements. Bribes get paid in countries where enforcement is minimal. Transfer pricing schemes shift profits to low-tax jurisdictions through artificial pricing of intercompany transactions. Fighting international fraud requires cooperation between regulatory agencies, accounting standard harmonization across borders, technology for tracking global financial flows, and legal frameworks enabling prosecution across jurisdictions. For you, as future accountants, international awareness matters practically. You might work for multinational corporations dealing with foreign subsidiaries, international transactions, and cross-border risks. You might investigate fraud schemes that span multiple countries. You might need to understand foreign accounting standards and how they differ from US GAAP. You might testify about international wire transfers, offshore accounts, or foreign business practices. Building cultural competence and international awareness now prepares you for the global reality of modern business and modern fraud. Research shows demographic patterns in fraud, but we need to discuss these carefully to avoid inappropriate stereotyping. Demographics help identify statistical patterns useful for risk assessment. Demographics should never be used to assume individual guilt or to discriminate in hiring, promotion, or monitoring. That distinction between aggregate pattern recognition and individual assessment is ethically crucial. The typical occupational fraudster statistically is male, middle-aged to retirement, educated, and experienced. But women commit fraud too, often with different patterns. Female fraudsters tend to commit smaller frauds over longer periods, occupy lower organizational positions, show higher rates of financial desperation motivating fraud, and get detected through control procedures rather than tips. None of this means women are more or less ethical. It reflects different access levels, different socialization around risk-taking, and different organizational positions creating different opportunities. Age patterns show that younger employees commit more collusive frauds, show less behavioral red flags like addiction, commit frauds that are larger but shorter in duration, and have less to lose in terms of career capital accumulated. Older employees committing fraud tend to act alone, show more behavioral red flags, commit frauds that are smaller but last longer, and have more to lose if caught, but also more sophisticated knowledge enabling fraud. Again, these are statistical patterns, not individual predictions. Education level correlates interestingly with fraud. Higher education doesn't prevent fraud, but it changes fraud sophistication. Educated fraudsters commit more complex schemes, exploit accounting knowledge to manipulate records, create more sophisticated concealment, and cause larger losses before detection. Less educated fraudsters commit simpler schemes that get detected faster, but still cause significant damage. Your education is powerful. Power can protect or exploit depending on character and choices. The practical application isn't profiling individuals based on demographics. That's discriminatory and often illegal. The application is understanding that different groups might face different pressures, access different opportunities, and develop different rationalizations. Prevention strategies should be universal, but with recognition that certain interventions might resonate differently with different populations. Support programs should be inclusive and accessible regardless of demographics. Monitoring should be consistent rather than targeted based on demographic characteristics. Risk assessment uses demographics as one factor among many, never as the sole determinant. This slide summarizes everything we've covered into one comprehensive fraud prevention framework you can reference throughout your career. Screenshot this, save it, review it when designing control systems, conducting fraud risk assessments, or investigating suspected fraud. This is your practical guide to thinking systematically about fraud prevention, rather than just reacting to incidents after they occur. Prevention Layer 1. Address pressure. Create employee assistance programs offering financial counseling, mental health support, addiction treatment, and crisis intervention. Provide competitive compensation, reducing financial desperation. Establish hardship loan programs and emergency assistance funds. Build organizational cultures where seeking help is normalized rather than stigmatized. Offer anonymous hotlines for discussing problems without fear. Remember that reducing pressure doesn't eliminate it completely, but it reduces the intensity and provides alternatives to fraud. Prevention Layer 2. Reduce opportunity. Implement strong internal controls, including segregation of duties, mandatory approvals, surprise audits, and continuous monitoring. Use technology to detect anomalies and flag unusual transactions automatically. Conduct thorough background checks before hiring for sensitive positions. Require mandatory vacations so someone else handles duties periodically. Maintain visible enforcement so everyone believes controls are real and effective. Document everything, because documentation creates trails that deter fraud. Prevention Layer 3. Challenge rationalization. Develop explicit code of ethics communicated regularly and reinforced consistently. Provide ethics training that discusses common rationalizations and why they're false. Ensure leadership models integrity through actions, not just words. Create reporting mechanisms where concerns can be raised without retaliation. Celebrate ethical behavior publicly to reinforce cultural values. Address ethical violations consistently regardless of who committed them. Make it culturally difficult to tell yourself this is okay when it clearly isn't. Prevention. Layer. 4. Limit capability. Match control strength to position authority, with strongest oversight for highest capability positions. Implement checks on executive authority through board oversight and external audits. Rotate responsibilities periodically so no one person controls critical functions indefinitely. Cross-train employees so knowledge isn't concentrated in single individuals. Use system access controls, limiting what individuals can do based on role requirements. Address arrogant behavior quickly before entitlement mindset becomes entrenched. This framework works because it's multi-layered. If one defense fails, others remain effective. It's proactive, addressing conditions before fraud occurs. It's comprehensive, considering psychological, organizational, and technical factors. It's practical, consisting of implementable policies rather than vague aspirations. And it's sustainable because it becomes part of organizational culture rather than temporary initiative. Organizations implementing this framework systematically experience dramatically lower fraud rates. Let me give you insight into what forensic accounting and fraud examination careers actually involve, because textbook descriptions often miss the reality. This is demanding work intellectually and emotionally. It's also fascinating work with strong career prospects and competitive compensation. Understanding what you're preparing for helps you make informed career decisions and develop relevant skills deliberately. Fraud examination combines accounting technical skills with investigative work. You'll analyze financial records looking for patterns, anomalies, and evidence of fraud. You'll conduct interviews with suspects, witnesses, and victims using questioning techniques designed to elicit information and assess credibility. You'll trace assets through complex transactions to determine where misappropriated funds went. You'll prepare reports documenting findings clearly for non-accountants, including attorneys, executives, and juries. You'll potentially testify as an expert witness, explaining complex financial matters in understandable terms. Each day varies depending on case requirements and investigation stage. The emotional dimension gets underestimated. You're investigating people who violated trust, which means dealing with betrayal, deception, and sometimes desperate human circumstances. Interviewing a fraudster who embezzled to fund cancer treatment for their child is emotionally difficult, even though the fraud must be investigated. Testifying against someone knowing your testimony might send them to prison weighs on you. Seeing good organizations damaged by trusted employees' betrayal affects you. You need emotional resilience, professional boundaries, and healthy coping mechanisms to handle the psychological load. Career paths in fraud examination include working for public accounting firms in forensic and litigation services, government agencies like the FBI, IRS, SEC, or state fraud bureaus, corporate internal audit and fraud investigation departments, consulting firms specializing in fraud prevention and detection, law firms supporting fraud litigation, and insurance companies investigating suspicious claims. Each path offers different work-life balance, compensation levels, travel requirements, and case variety. Research options thoroughly define the best fit for your preferences and priorities. Compensation is competitive with the specialized skills and high stakes involved. Entry-level forensic accountants earn $55,000 to $70,000 depending on location and employer. With experience and certifications, salaries increase to $80,000 to $120,000. Senior forensic accountants and fraud examination managers earn $120,000 to $180,000. Partners in forensic practices or senior government positions can earn $200,000 plus. Beyond salary, you're building expertise that creates job security, because fraud, unfortunately, isn't disappearing. and organizations constantly need skilled examiners. Professional development matters significantly in this field. The Certified Fraud Examiner designation from ACFE is industry standard. The Certified Public Accountant license provides credibility and career flexibility. The Certified Forensic Accountant, or Certified in Financial Forensics credentials, adds specialized recognition. Continuing education keeps you current on emerging fraud schemes, technology tools, and legal developments. Your learning doesn't end with your degree. Your degree provides foundation for continuous professional growth throughout your career. Let's apply everything we've learned to a real case scenario. This helps consolidate theoretical understanding into practical application. Patricia Smith, controller at Byral Acura, embezzled $10.3 million over several years. Let's analyze this using our frameworks to see how theory explains reality and how theory informs prevention. Fraud triangle analysis. Pressure. Smith faced financial pressures not fully disclosed publicly, but embezzlement at this scale suggests significant motivation, perhaps personal debt, family obligations, lifestyle maintenance, or addiction. Whatever the specific pressure, it was intense enough to motivate massive fraud despite years of honest service. Opportunity. As controller, Smith had authority to process transactions, knowledge of control weaknesses, access to accounts, and ability to manipulate records. The dealership likely lacked segregation of duties, secondary approval requirements, or surprise audits that would detect fraud. Rationalization. Smith probably convinced herself through common narratives. I'll pay it back. The dealership can afford it. I deserve this. Or nobody appreciates me anyway. These rationalizations allowed her to maintain self-image as fundamentally honest, despite massive theft. Fraud action triangle analysis provides different insights. The act involved creating false transactions that diverted dealership funds to Smith's control, potentially false vendor payments, unauthorized withdrawals, or manipulation of customer receipts. Concealment required manipulating records to hide missing funds, defeating control procedures, and avoiding detection during any reviews or audits. Conversion meant Smith used embezzled funds for personal benefit, purchasing assets, paying debts, or funding lifestyle. Tracing how she converted and used funds would be critical for recovery efforts. Behavioral red flags probably appeared before financial detection. Lifestyle beyond controller salary would have been visible to colleagues. Resistance to sharing duties or taking vacation might have occurred. Defensive reactions to questions about accounts could have emerged. Behavioral changes from stress might have been noticeable. The tragedy is these red flags were either missed or ignored until financial symptoms became undeniable. Prevention opportunities existed at multiple points. Stronger controls requiring dual signatures for large transactions would have prevented single-person fraud. Mandatory vacation policies would have required someone else to handle Smith's duties temporarily, likely discovering irregularities. Regular surprise audits would have detected anomalies earlier, reducing total losses. Segregation of duties where different people process transactions and reconcile accounts would have made fraud far more difficult. The dealership paid $10.3 million to learn these lessons. Your future organizations don't need to repeat that expensive education. Investigation of this fraud required tracing all fraudulent transactions, identifying concealment methods, determining total losses, recovering any traceable assets, preparing evidence for prosecution, and testifying about findings. This illustrates the complete fraud examination process from detection through resolution. Understanding cases like this prepares you for the complexity of real investigations and the importance of thorough documentation throughout the process. We need to talk about your personal ethical foundation because everything we've discussed about fraud ultimately comes down to individual choices. You're building accounting and business knowledge. That knowledge is powerful, but knowledge without character is dangerous. The combination of capability plus integrity creates the professionals organizations need and trust. Let's talk about building and maintaining that integrity throughout your career. Ethics aren't situational. You can't be honest when it's convenient and flexible when it's difficult. Integrity means consistency, doing what's right, even when it's costly, unpopular, or risky. Your ethical foundation gets tested when you face real pressure. When your boss asks you to book revenue early to hit quarterly targets. When a client pressures you to approve questionable accounting treatments. When you discover fraud by someone you like and respect. How you respond in those moments defines your character and determines your career trajectory. Choose integrity, always. Building ethical resilience requires several practices. First, clarify your values before crisis hits. What principles are non-negotiable? What lines will you never cross, regardless of consequences? Deciding in advance prepares you to act consistently under pressure. Second, develop support networks, including mentors, peers, and friends who share your values. When you face ethical dilemmas, having people you can discuss them with provides perspective and reinforcement. Third, practice ethical decision-making in small situations. Minor integrity choices prepare you for major ones. Padding an expense report by $10 normalizes dishonesty that could later enable padding by $10,000. Recognize that ethical violations rarely involve obvious choices between right and wrong. They involve choices between competing goods, between loyalty to different stakeholders, or between short-term benefit and long-term integrity. Your boss pressuring you to manipulate accounts isn't twirling a mustache while asking, "Will you join my evil scheme?" They're framing it as being a team player, understanding business realities, or showing flexibility during temporary challenges. The manipulation is subtle. The rationalization is provided for you. You need sufficient ethical clarity to recognize these situations and sufficient courage to resist them. The long-term benefits of integrity outweigh any short-term benefits of compromise. Your reputation for honesty becomes your most valuable asset. Organizations seek ethical accountants because they cannot afford the risk of fraud, litigation, or reputational damage from unethical employees. Clients and employers pay premium rates for accountants they can trust completely. Integrity creates career opportunities that dishonesty forecloses. You might think everyone cuts corners, I'll be at a disadvantage if I don't. But research and experience show the opposite. Integrity distinguishes you positively and creates sustainable career success. Finally, remember that mistakes happen, and ethical failures don't define you permanently if addressed honestly. If you make an error or exercise poor judgment, acknowledge it immediately. Take responsibility without excuses. Correct the situation as completely as possible, and learn from the experience. The cover-up is typically worse than the crime. The denial compounds the offense. Owning mistakes demonstrates the character that organizations value. Your integrity isn't perfection. Your integrity is consistency, honesty, and accountability. The future of fraud, technology, AI, and emerging risks. Before we wrap up, let's look forward at how fraud is evolving with technology and what that means for your careers. Fraud doesn't stay static. Fraudsters adapt to new technologies, exploit emerging vulnerabilities, and develop novel schemes constantly. Staying ahead of fraud requires understanding where risks are heading, not just where they've been. Artificial intelligence and machine learning create both fraud detection opportunities and fraud scheme possibilities. On the positive side, AI can analyze massive transaction data sets identifying patterns humans would miss, detect anomalies in real time rather than after the fact, predict fraud risk based on behavioral patterns, and automate routine monitoring, freeing humans for complex investigation. Organizations implementing AI fraud detection report dramatic improvement in early detection and prevention. But AI also enables more sophisticated fraud. Deepfake technology creates convincing fake audio and video that could be used for CEO fraud schemes, identity theft, or fabricated evidence. Automated bots can execute fraudulent transactions at scale far exceeding human capability. AI-powered social engineering can personalize phishing attacks, making them more convincing. Machine learning could potentially identify control weaknesses and optimal exploitation methods. The arms race between fraud detection technology and fraud execution technology will define coming decades. Cryptocurrency and blockchain technology create new fraud vectors. While blockchain provides transparency and immutability, theoretically reducing fraud, Cryptocurrency transactions enable anonymous value transfers, money laundering through complex transaction chains, ransomware schemes demanding untraceable payment, and investment scams exploiting victim confusion about how crypto works. Fraud examiners need to develop cryptocurrency tracing capabilities, understand blockchain analysis tools, and stay current on crypto-specific fraud patterns. Remote work environments that accelerated during COVID-19 create different fraud risks than traditional offices. Physical access controls become less relevant when employees work from home. Segregation of duties becomes harder to maintain when people aren't physically present. Social isolation reduces the casual interactions that might reveal warning signs. Digital transaction trails become more important when paper documentation decreases. Organizations must adapt control systems to distributed workforce realities. Your preparation for the future requires technical skill development beyond traditional accounting. Learn data analytics tools like Python, R, or specialized fraud detection software. Develop understanding of cybersecurity concepts, since fraud increasingly exploits technology vulnerabilities. Stay current on emerging technologies and their fraud implications. Build continuous learning habits, because what's cutting edge today becomes obsolete tomorrow. The accountants who thrive will be those who combine strong foundational knowledge with technological adaptability and commitment to lifelong learning. The fundamental human elements persist despite technological change. Pressure, opportunity, and rationalization still drive fraud. Trust violations still damage organizations. Behavioral red flags still precede financial symptoms. The tools and techniques evolve, but the psychology remains remarkably constant. Master the fundamentals we've covered today, then layer technological capabilities on that foundation. That combination makes you valuable and employable, regardless of how specific technologies evolve. Let's step back and see how everything we've covered connects into one comprehensive understanding of fraud. We've built knowledge progressively, layer by layer, and now it's time to see the complete picture. Fraud is multidimensional, simultaneously psychological, organizational, and technical. Preventing it effectively requires addressing all dimensions simultaneously, rather than focusing narrowly on any single aspect. The psychological dimension includes understanding human motivation through pressure, rationalization, capability, ego, and specific motivators like MICE. This dimension recognizes that fraud is a human behavioral problem before it's an accounting problem. People make choices based on circumstances, character, and cognition. Understanding their decision-making process enables you to influence decisions through environmental design and support systems. You cannot control people's minds, but you can shape the conditions under which they make choices. The organizational dimension encompasses culture, controls, oversight, and structural factors. Organizations create conditions that either enable or prevent fraud through the systems they design, the behaviors they reward, the violations they tolerate, and the values they actually practice versus merely proclaim. Organizational design is fraud prevention strategy. Every policy, procedure, and cultural norm either increases or decreases fraud risk. This dimension emphasizes that fraud prevention is organizational responsibility, not just individual ethics. The technical dimension involves accounting systems, internal controls, audit procedures, and forensic investigation methods. This is where your professional education provides capability. Knowing how to design controls that actually prevent fraud, how to test controls for effectiveness, how to investigate when fraud is suspected, and how to document findings for legal proceedings gives you practical skills organizations need. Technical capability without understanding psychological and organizational dimensions leaves you mechanically competent but strategically limited. Combining all three dimensions makes you genuinely expert. The integration appears in how fraud occurs and how prevention works. Individual psychology meets organizational environment at the decision point where someone chooses fraud or integrity. Pressure from personal circumstances combines with opportunity from weak controls and rationalization from poor organizational culture to create the conjunction of events enabling fraud. Break the conjunction by addressing pressure through support, reducing opportunity through controls, and challenging rationalization through culture. The three-dimensional approach attacks the problem from multiple angles simultaneously. Investigation and response require the same integrated thinking. You're tracing transactions technically, analyzing behavior psychologically, and assessing organizational factors that enabled fraud. Your investigation report should address what fraud occurred and how it was executed technically, who committed it, and what motivated them psychologically, how organizational weaknesses enabled it, what behavioral red flags appeared before detection, how similar fraud can be prevented going forward, and what systemic changes would reduce future risk. This comprehensive approach serves organizations far better than narrowly technical analysis. Your development as fraud examiners should mirror this integration. Build technical accounting and auditing skills through your coursework and certifications. Develop psychological insight through studying human behavior, conducting interviews, and learning to read behavioral indicators. Understand organizational dynamics through business experience, leadership development, and systems thinking. The combination creates capabilities that make you valuable across industries, contexts, and career stages. This is expertise worth developing deliberately and continuously. You've absorbed a massive amount of information over the past 75 minutes. Now let's talk about practical next steps. What should you actually do with this knowledge? How do you move from understanding fraud theory to preparing for fraud examination careers? Here's your action plan starting immediately. First, complete the comprehensive case study in the downloads. This case involves analyzing a fraud scenario, identifying red flags, assessing control weaknesses, determining how fraud was committed, and recommending prevention strategies. Allocate 90 to 120 minutes for thorough analysis. Don't rush it. Sit with the complexity. Let yourself struggle with ambiguous information. That struggle develops judgment that distinguishes good examiners from great ones. The case provides answers, but attempt it independently before reviewing solutions. Active problem solving builds skill that passive review cannot. Second, start following fraud news through resources like the Association of Certified Fraud Examiners website, fraud blogs and podcasts, business news coverage of white-collar crime cases, and academic research on emerging fraud patterns. Understanding current fraud schemes keeps your knowledge contemporary. Reading about actual cases helps you see how theory manifests in practice. Following investigations develops understanding of detection methods and legal processes. Make this ongoing habit rather than one-time activity. Expertise requires staying current continuously. Third, consider certification paths based on your career interests. The Certified Fraud Examiner designation requires work experience and exam passage, but provides industry-standard credential. The CPA license remains foundational for accounting careers with fraud examination specialization available. The Certified in Financial Forensics credential specifically targets forensic accountants. Research requirements for each. Assess which aligns with your goals, and begin working toward qualification. Certifications signal commitment and competence that employers value highly. Fourth, develop complementary skills beyond accounting. Take courses in psychology to understand human behavior better. Study criminal justice to understand legal processes. Learn data analytics to harness technology for fraud detection. Develop interviewing and communication skills for investigation work. Build business understanding through management and strategy courses. The best fraud examiners are broadly educated, not narrowly technical. Look for skill development opportunities across disciplines throughout your education and career. Fifth, seek relevant experience opportunities. Internships with public accounting firms, forensic practices provide exposure and networking. Government agencies offer student positions in fraud investigation units. Corporate internal audit departments provide experience with control testing and fraud prevention. Even entry-level accounting positions develop transaction understanding and control familiarity that serve fraud examination careers. Build resume while building skills through deliberate experience choices. Finally, network with professionals in the field. Attend ACFE chapter meetings where fraud examiners gather locally. Connect on LinkedIn with fraud professionals whose work interests you. Participate in accounting professional organizations that include fraud examination focus, Seek informational interviews with people working in roles you aspire toward. Networking isn't just about job searching. It's about learning from practitioners, understanding career realities, and building relationships that support professional development throughout your career. Let me provide specific resources that will support your continued learning beyond this lecture. Success in accounting and fraud examination doesn't require solitary struggle. Communities, resources, and support systems exist to help you develop expertise and navigate challenges. Use them deliberately. Professional organizations offer tremendous value. The Association of Certified Fraud Examiners provides fraud examination training, certification programs, local chapter networking, annual conferences, and publications, including the Journal of Fraud Research and the Fraud Magazine. Student membership is inexpensive and provides access to resources worth far more than membership cost. The AICPA offers forensic and valuation services resources, continuing education, and the Certified in Financial Forensics credential. State CPA societies provide local networking and regional education opportunities. Academic resources support continued learning. Academic journals publish current research on fraud patterns, detection methods, and prevention strategies. Access these through your school library databases while you have student access. Download articles relevant to your interests for future reference. Textbooks on forensic accounting and fraud examination provide comprehensive reference materials. Build a professional library you'll reference throughout your career. Consider it investment in your future capability. Online learning platforms offer flexibility for skill development. Coursera, LinkedIn Learning, and Udemy provide courses on data analytics, interviewing techniques, financial crime investigation, and related topics. Many are affordable or even free. Certificate programs signal completion and provide structured learning paths. Take advantage of these resources to fill knowledge gaps and develop complementary skills beyond what your degree program covers. Government resources provide surprising value. The FBI, IRS, and SEC publish fraud alerts, investigation techniques, and case examples that illustrate fraud in practice. The Department of Justice releases case documents from major fraud prosecutions. These public resources provide real-world examples and investigation insights directly from practitioners. Reading actual legal documents develops understanding of evidence requirements and prosecution strategy that textbook case studies cannot fully capture. Peer support matters tremendously. Form study groups with classmates taking fraud examination courses. Your peers are traveling similar journeys with similar challenges. Teaching each other reinforces your own understanding while building collaborative problem-solving skills. Plus, these relationships often become professional networks after graduation. The classmates struggling through fraud examinations with you today might be colleagues investigating actual frauds together in 10 years. Mental health and well-being resources deserve mention because this career involves stress, ethical dilemmas, and emotional challenges. Your school's counseling center provides confidential support for managing anxiety, processing difficult situations, and maintaining well-being. Use these services proactively rather than waiting for crisis. Professional counseling develops coping skills and resilience that serve you throughout high-stakes careers. Taking care of your mental health isn't weakness, it's professional preparation for demanding work. Office hours and instructor access matter more than most students realize. If concepts from this lecture remain unclear, if you want to discuss career paths more deeply, or if you need guidance on specific situations, reach out. Email is provided in the course materials. Office hours are scheduled times specifically for student questions and discussions. Don't struggle alone when help is available. Asking for clarification demonstrates engagement and commitment to genuine understanding. That's exactly the mindset that succeeds in this field. Before we finish, let's zoom out to the bigger picture. Why does fraud examination matter beyond just being a career option or course requirement? Understanding fraud and working to prevent it contributes to something larger than paychecks and professional credentials. You're participating in creating trustworthy business systems that enable economic prosperity, protecting vulnerable people from exploitation, maintaining confidence in institutions that society depends on, and upholding ethical standards that make cooperation and commerce possible. Fraud destroys trust, and trust is the foundation of economic systems. When people cannot trust businesses to provide real value for payments, when investors cannot trust financial statements to accurately represent organizational performance, when employees cannot trust employers to treat them fairly, economic exchange becomes difficult or impossible. Fraud examination work maintains trust by detecting and deterring violations. Your career might prevent frauds that would have destroyed small businesses, devastated retirement savings, or bankrupted individuals. That work matters profoundly, even though specific impacts often remain invisible. The victims of fraud deserve consideration. Behind every fraud case are real people who suffered real losses, employees whose retirement funds disappeared because executives manipulated stock prices, consumers who paid for products that didn't work as advertised, investors who lost savings to fraudulent schemes. Fraud transfers wealth from victims to perpetrators through deception and betrayal. It's theft dressed up in business clothes. Fighting fraud isn't abstract accounting work. It's protecting people from exploitation and working toward justice when exploitation occurs. Systemic fraud threatens societal institutions. When major corporations commit massive frauds like Enron, WorldCom, or the 2008 financial crisis, public confidence in business markets and capitalism itself erodes. People question whether systems are rigged against them. They lose faith in fairness and meritocracy. They become cynical about institutions and leadership. Fraud examination that holds powerful actors accountable, that prevents systemic corruption, and that maintains integrity in business operations, protects democratic capitalism from self-destruction through greed and deception. Your choice to study fraud examination, to build expertise in detection and prevention, and potentially to pursue this career path contributes to this larger project. You're not just earning credentials or building careers, though those are legitimate goals. You're also choosing to be someone who stands for integrity, who protects trust, who fights exploitation, and who maintains standards in systems that benefit everyone. That's meaningful work. That's purpose beyond profit. That's contribution worth making regardless of compensation levels or recognition. The ethical dimension extends to how you do this work. You must investigate thoroughly but fairly, treating suspects with dignity even while documenting violations. You must pursue truth rather than confirming biases. You must respect confidentiality while ensuring accountability. You must balance organizational interests with individual rights. This work gives you power over people's careers, reputations, and freedom. Wielding that power ethically requires constant vigilance about your own motivations, biases, and limitations. The best fraud examiners combine technical skill with ethical humility and genuine commitment to fairness. We've reached the end of this lecture, but this is actually just the beginning of your fraud examination journey. You've built foundational understanding of who commits fraud and why, the psychological and organizational factors that enable fraud, behavioral indicators that signal fraud risk, prevention frameworks that actually work, and career paths where you can apply this knowledge. This foundation positions you ahead of most business professionals who never study fraud systematically. Now comes the work of deepening that understanding through practice, experience, and continued learning. What you've accomplished today deserves recognition. 75 minutes ago, fraud was probably a vague concept you associated with criminals and corruption. Now you understand the fraud triangle and its components, MICE motivations, situational versus predatory fraudsters, collusion dynamics, the fraud scale, the triangle of fraud action, behavioral red flags, prevention strategies, and career opportunities. That's substantial progress. You went from casual awareness to structured understanding of a complex domain. Feel confident about that growth. You earned it through sustained attention and intellectual engagement with challenging material. Your next steps depend on your career interests and goals. If you're pursuing fraud examination professionally, follow the action plan from earlier. Complete the case study, obtain relevant certifications, develop complementary skills, seek appropriate experience, and network with practitioners. If you're pursuing other accounting paths, apply fraud awareness to whatever role you fill. Every accountant should understand fraud risk, recognize red flags, and contribute to organizational integrity regardless of specific job title. The knowledge you gain today makes you better at any accounting role you choose. Remember that expert fraud examiners aren't born fully formed. They're developed through deliberate practice over years. Every expert was once a beginner who felt overwhelmed by complexity. Every seasoned investigator once struggled with technical concepts. Every certified examiner once questioned whether they could master this material. Your feelings of challenge, confusion, or inadequacy are normal parts of learning. They're not signs of failure, they're signs of growth happening. Embrace the struggle, learn from mistakes, persist through difficulty. That's how expertise develops for everyone without exception. The fraudsters you'll eventually investigate or prevent have one advantage. They're motivated by greed, desperation, ego, or ideology. They're willing to sacrifice ethics for gain. But you have bigger advantages. Knowledge systematically developed, skills deliberately built, integrity that enables clear thinking, organizational support and resources, and legal authority backing your work. They're operating in darkness, hoping not to be seen. You're bringing light systematically applied through professional expertise. Light always reveals darkness eventually. Your job is being the light. This lecture gave you theory and framework. Practice gives you skill and judgment. Combine them throughout your career. Keep learning. Stay curious. Question assumptions. Investigate thoroughly. Think critically. Act ethically. Support colleagues. Protect organizations. Serve justice. That's the path from today's foundation toward tomorrow's mastery. The journey continues. Make it count. Make it real. Make it yours. Thank you for your attention and engagement. Now go apply what you've learned, continue building expertise, and contribute to creating business systems worthy of trust. The profession needs people like you who combine capability with character. Be those people.